Hello and welcome everyone to another weekly market commentary from StashAway. Of course, with me joining today again is our Chief Investment Officer, Freddy Lim. Hey, Freddy.
Hey guys, good to see you again.
Yes, good to see you again as well. We can get right to it as well, huh? We had quite a few questions again, so thank you again for everyone submitting those. Keep doing that. This is, very, very important for us because we want to hear what is on your mind so that, Freddy can address them head on. With that being said, Freddy, quick market update. There's obviously on Wednesday this week, there is the Fed Open Market Committee meeting, right? So that is anticipated by the markets and by the participants. And then obviously stimulus talk, right? It's running out on Friday, the first round pretty much. So the US government, the House and the Senate are really scrambling right now to actually get something passed. But let's start with the Fed.
Yes and no. The Fed, the Fed is essentially going to stand behind the markets. The messaging is not going to change, but they're not going to show their hands again so soon. They want to put the pressure on Congress to start helping the real economy more, right? As we always mention, the Fed's financial engineering helps disconnect the market from the real gloom and doom in the real economy. But the real economy does need its own help directly from the government. So the Fed's message is going to try to sound like the waves is not over. There's still a long road ahead. The government needs to do more, but the Fed is ready to stand behind the market whenever necessary. So that's not going to change.
Yeah. So we'll see what happens, but I, must agree they already said what they were going to do, right? Whatever necessary. So I don't think we need much more wording from them on that end, from the Fed direct. But stimulus, right? Obviously, this hits much more home, right? To the American people, also
Yes.
to companies. And the economy itself. So that has much bigger impact. Where do you see them stand? And maybe you can give a quick overview of what are the negotiation points right now, or where we're standing there?
Yes, officially the CARES Act that pays out $2.9 trillion of aid, which includes the $600 per week of support for individuals, is officially expiring this week. I think if not right now, it's expiring by the end of July. The thing is that the pressure is on, but the rift is far apart. The Democrats have proposed something like $3.5 trillion of additional support, whereas the Republican side wanted no more than $1 trillion. So it's very disunited on the Republican side, and the Senate House leader, Mitch McConnell, he's a Republican.
Yeah,
He has to strike a fine balance between the absolute number, right? He's pushed it to the limit and 1 trillion. I think that's as far as what they can agree on. But there's some details like they want to put in where the Democrats are not going to agree to. And the main problem, the main pickle right now is liabilities protection for companies, for universities, for any employers, right? Just think about it. Students that's attending Harvard University, for example, they could not go in physical presence, not able to network, and still pay the fees. And there's a lot of class actions by students suing those institutions. Liabilities for protection includes this, right? And workplace infection, who's liable to, to pay back for the sufferings of whoever contracted the diseases at work, right?
So especially in the factory settings, it seems like, especially meat processing plants, not just in the US, but it happened in Europe as well, right? Like it's an environment that's cold. The virus thrives there, and you see these spreads, right? So I can tell, especially in the US, when people with lawsuits being readily accepted by courts, right? Always the risk is there quite high for the employers as well.
Yes, in the case of meat packing plants, by design is tight. It's a closed chambers. It's impossible to do safe distancing. And how is someone going to help them out? So those things are sort of what the Republicans are very insistent on, but the Democrats are not going there. So we have a big rift in absolute numbers and also with items such as liabilities protection.
Yeah, I think all good points. I think we mention it last week as well with the European Union, right? They always fight, and then it gets extended after all. But they will come probably here to a conclusion, obviously, right? Because I think the American public will demand something here. But again, this might be a little bit out still. So let's get to the questions. The first one came actually through from our client engagement team, right? Someone dialed in or must have sent them a message or email. He's saying, can I send a question to Freddy, please, for discussion? He's asking, how does the money multiplier by the Fed, which has propped up the markets to date, tied to the claim in the media that retail investors are the ones pushing the market higher? Assuming retail investors are not direct beneficiaries of the Fed's monetary policy.
Yes, it's true. The retail investors are, well, they are indirectly, if you are employed and you're getting checks in the mailbox, for sure you are a beneficiary, but you are lesser beneficiary than, say, an airline now, right? Not needing to go to Congress to beg for money, but now you can issue a new bonds and the Fed can purchase that long-term data bond and you get to kick the can down the road for sure. So, but it's just a relative magnitude. But we are all beneficiaries in a way. But it's not true. It is like the questions has said, it's a media claim that retail investors, the dumb money, they always like to use the word dumb money, which I personally do not agree. Yeah. Retail investors is the winner this year, by the way. Yeah. I would say that the retail money, there are inflows, but it's not the majority of the inflows. When you compare to the size of the stimulus that's coming in, it's a pickle, right? It's a drop in the ocean. So it's a media claim, like the question has said, is not a fact. And so I would say that it has no relationship. If there's any, I do not know of, or I have not come up with one.
Good. Let's move on. To Milan, he's asking us, hey, StashAway, why are the StashAway Simple's projected returns are different between Malaysia at 2.4% and Singapore at 1.9%? So maybe, Freddy, you can clear up a little bit, how do we get to the return and why is it different for each of the different countries?
They are simply completely different markets. StashAway Simple in Singapore are securities, commercial papers, bills, fixed Ds, account receivables, safe quality names that we source within Singapore itself, has no currency risk. Similarly, in Malaysia, Malaysia has its own market, its own structure, right? For one, the short dated interest rate in Malaysia is higher than Singapore. So there's already a difference in terms of the natural rate of interest, right? Interest rate in both markets. So that's the majority of the difference. The names is all available on there, right? So it's just entirely different underlying assets, not to be comparable, but they are equivalently money market funds, high quality names for their own respective domestic markets.
Yeah, thanks to Milan for that question, because I think maybe a lot of people had that same one as well. Let's move on to the last one, Freddy. Let's take one more. It's from Gary. He's asking, do you have any comments about the outlook for the Singapore-based income portfolio in the short to medium term? Also, given that the market recovery is stronger than expected so far, would StashAway consider re-optimizing again? And if yes, what kind of assets are being considered?
Officially, ERAA is in an all-weather strategy. So whether the market recover or not, we still have to look forward, not to the past, and look at risks in a forward-looking basis. And we are actually globally in an all-weather strategy at StashAway. Returns are still doing well, even as markets doing well, but it is quite separated. We have adopted a less aggressive strategy that still managed to perform well. The key thing for Singapore income portfolio is that it's a fine balance between a lot of protective and growth-oriented assets. Very balanced. It's got the right balance right now from a risk management angle. Where it's quite pivotal outside the balancing act is in the REITs sector, where we have about 35 percentage point roughly of the portfolio in REITs. And so one may say that, well, what's the outlook on REITs? And that sort of had a certain impact on the portfolio, right? We have done some studies, and JP Morgan, we also have seen their numbers. I think JP Morgan felt that under their scenario and their framework, which is completely different from ours, they came up with a risk number of 10% price risk for REITs over 2 years. But they also concluded that the ability to pay dividends is high, and the ability to have dividends cover that price risk is actually very high. And dividends currently is higher than, in terms of the ETFs, they are higher than that 10% price risk. And that's JP Morgan studies. The StashAway study is 12.5% price risk over 3 years, where in our scenario, we assume that things are worse. No one goes to the mall. There's zero cash flow for 3 years. There's no relief. There's no support. Nothing happens. It's like a worst case scenario. And we sort of simulated that a lot of REITs needed to raise cash, raise shares, raise capital to continue to finance the dividend payments, and for a period of 3 years before things improved. In the very, very gloomy scenario, we have evaluated that the price risk is manageable at around 12.5% over 3 years. That's well covered by more than 16% in dividends, nearly 17% in dividends. So overall, they are just scenario analysis, but our assumptions are quite bleak and they are still manageable. So in a way, the outlook for Singapore income portfolio is that it's exactly the right mix between growth and protective. It's exactly in the right balancing act, the right risk management profile for the COVID-19 world. So it is right already. Re-optimization will be done whenever the numbers came in and tell us that there's a need, right? But it does not relate to the market has gone up already. That doesn't really factor into as a factor. We got to look forward beyond what's already happened, right?
Yeah, absolutely. And Gary, thank you for the question. I think a great one, especially for our Singapore-based income portfolio investors on the platform. Let's move on. We have a few webinars coming up. Before I mention the webinars, I do want to let everyone know who hasn't heard about it yet, but we did also launch our StashAway podcast. It's called In Your Best Interest. So if you want to learn more about different asset classes, financial planning, or entrepreneurship, feel free to have a listen there. You can sign up on Spotify, iTunes, or wherever else you get your podcasts usually. Other than that, we have some webinars coming up next week. For Singapore, we'll be talking about how to plan for your retirement. So if you want to learn how to optimize your CPF and SRS, join us on Thursday, the 6th of August. And for Malaysia, the upcoming webinar is about investment basics. That's on Wednesday, the 5th of August. And for both of those, you can sign up on our website. There's links in the show notes below as well. And otherwise, Freddy and myself will be with you, as always, next week. Until then, have a wonderful rest of your week or weekend, whenever you're listening to this. See you shortly. Bye-bye. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.